Hi, everybody. Ingmar, Shepard, Brock, Mark, my trading warrior brothers and sisters. Everyone doing okay? Newsflash, I was wrong. Way underestimated this move in the metals. Okay, so it happens. Pretty positive it won't be the last time I am. Fortunately, got out of the way, and fortunately, it wasn't silver. But wow, what can you say? So again, it's not price, it's how it gets to price. And after we did this, the acceleration phase turned in. But I think I was told yesterday by, I don't know, Georgiano, a Greek name, told me to that was dangerous.
Gregorius.
Gregorios told me it
Yeah.
was dangerous to short crude yesterday on the turnaround Tuesday trade. It was dangerous. This is when it was put out. Okay. It's a risk a buck. And it pulled back. And actually, look, we got a little 1, 2, 3 before the high. Oh, thank you, Peter. And, you know, you'd have a buck in it. You had a buck in it. And actually, it's possible if we close under 40 and a half and we're getting some, 4-hour sell signals, we close back under 40.50, which is right here, this green moving average. You have a 2-week reversal. So, it's a great example of knowing the relative strength of markets, because it took all of this, right, for the last several weeks, strength and risk, for oil to finally take out the high from June 23rd on the solstice. So, it took a month of pretty aggressive risk on to finally register a new high. So this was definitely the weak sister. I still think it's a weak sister and could be topping. And I look at the S&Ps here. If we could just start trading back under 3,200, there'd be a problem with it. NASDAQ has even less relative strength. What was interesting about NASDAQ, and maybe it's unfinished business, is last week we talked about the key reversal. It hadn't happened since .com era key reversal. And the high yesterday actually did not take out this high. I think it went right to it. I almost would have been more bearish if it had taken out stops, but now there are stops in NASDAQ above these highs. Of course, the dollar's following through to the downside after the breakdown. I don't see any reason to fade it.
And whatever you do, don't look at silver.
I did.
Oh,
Wild.
yes.
Yeah. Wow.
The real squeeze has begun.
Wow. Yeah, I mean, it's an amazing move. I haven't seen this since I don't know, 70s. Although we've had a couple of $50 moves since then. Yeah,
Twice.
it looks great. Twice? 50?
Silver has been to 50 twice.
Yeah, the Hunt brother squeeze, and then
exactly the Hunt brothers squeeze in the 80s.
Late 70s. Yeah.
And the second time was, before we got the crash, from which after a long period of time we're now recovering. I mean, I think it's more or less pretty obvious that
just
something
a character.
Something different is happening here in silver.
The character of the candles. Well, it certainly didn't hurt the metals to be in acceleration phase for Dixie to break down. So if with this Dixie breakdown, and it not being able to recapture the breakdown, to me, it looks like 92 is coming. So what's that, about 120 euro? So that's what it looks like to me. Yeah, may keep equities alive too. We'll see. You know, it's very unusual to come in the morning and see the metals screaming and the S&P's down 5 handles and the NASDAQ only up 12 points. Okay. It's there's something going on that's a little change of character. Usually it'd be, you know, S&P's up 30 handles and gold up $5, $10, but the action is shifting a little bit. Richard says silver $50 in the 80s is equivalent to 250 today. Good point.
He has a good point. Yeah, because since then we had obviously a huge amount of accumulated inflation. There's no question about it. But still, as you very well know, Coach, price has memory. So irrespective of the fact that adjusted for inflation, it was a much higher price. I think it still plays a role that, you know, we in essence had found some kind of a long-term double top there. I think next time we're at 50s, it's going to be a charm.
Okay, Ben saying it's consistent with the cycle work, that change. Okay, so I have to say, Steve, that your call for 42.40 in crude, when I saw it up there yesterday, I thought about what you were saying about that level, and that helped. And, you know, nice call. And
it
then
was the minimum target once we broke to new highs.
Yeah, to me, it looks like back under, you know, for sure $39, we could get, you know, a decent correction here. I mean, look how long we've been sideways here. So, you know, first moving average comes in around 37 down here, and we get through that. I remember you talking 28 as a possibility.
29, yeah, 29.
Yeah, that's this resistance. It looked like the head and shoulders kind of line, neckline that we have here, and that would still not put it in a bear market, but it'd be a nice trade. So that's what I have. I want, you know, the team, I think maybe it was just Greg and I that may have been looking for some type of top in the gold, but the rest of the team were for months and months and months, don't short gold, don't short gold. And Blake had targets that we're achieving now that seemed, you know, a little bit, you know, aggressive 3 months ago, but here we are. So thanks for keeping, plus made money being, Greg made money being long the metals, Blake made money being long silver. So if you're hanging out with us and you ignored me, you did pretty good. So congratulations.
I wonder what Henrik is doing. Why don't you bring him for a special?
Okay, I'll invite him. And you know what, guys? If you have windfall profits in metals and you're booking something, you know, don't get sloppy after a windfall. It's happened to me. You know, you have a big windfall, and then you start getting a little sloppy. You get hubris a little bit, and then you try and rationalize it by saying, "Well, it's house money." It's not the house's money anymore. It's your money. Protect it like it's your last, you know, 10, 20 grand. Okay. So, Blake, nice trading. Also, you know, look, the theme of a weaker dollar. Steve had a great tip in Aussie. So there it is, 1.619. And most of the active pattern in play, and Blaker just took NASDAQ in, NASDAQ, Kiwi. And then Blake's long looking for 117.89. So plenty of great reasons to become part of the community. I think you see him every day.
You know, Dale, while you're on there, just for those people that aren't part of the Forex analytics community. If you see the cable, I was long cable all day yesterday.
Yeah.
Took at 127.60, took half of my position off. Right at the end of the day, I took the rest off at 127.39. And I told everybody in the chat room, I'm like, look, I'm going to buy a dip. This is last night. I'm going to buy a dip when it, try to get a dip in overnight. And I ended up buying the cable at 126.80 last night.
Okay.
And so even though I kept the pattern in play on, because overall I'm bullish, it doesn't mean that. And I try to explain to people that
you trade around these pips. You're not locked into it.
Correct. I was long a bunch of euros yesterday, and I've been in and out, and same with the cable. I don't. Those should provide more of a directional bias for traders versus, just get in because it says it's, you're long, and then it, closes and you're like, oh, I need to get out. No, it's more of a, like I said, it's a directional bias. Like, look, I'm going to be bullish the cable till it gets to about 131, 130, somewhere up there. And then I'll reevaluate at that point. Or the euro dollar, we're in the middle of a bull flag. It's, it looks like it's going to 118. So in between here and 118, I might be in the euro, 5 or 6 different times on the long side. So that really hopefully will help you guys understand how I feel about, the patterns in play. I'll let you finish up.
And I think people know, if you're a discretionary trader, no one's going to click the mouse for you. Okay. So guidelines, it's up to you to manage the trade, to take partial profits, and to hold or not hold. So, if you just want money to fall into your account, you should probably just go find a good money manager. It's easier than putting in 10 hours a day yourself or more. But if you want to be a discretionary trader, it's hard work, and you have to own everything you do, and you're the one controlling your destiny by clicking. So, okay, Blake, so why don't you give us an update on the follow through we're getting in a lot of these markets here today?
Yeah, we are. The dollar's obviously looking pretty strong, and I'm going to go ahead and take over and go over the bias chart and get that done for you guys.
Hey, Blake, I was going to ask you, ever hear of a guy named Meb Faber? Because like a lot of the, anyway, he's going to be with us today. Meb Faber. Cambria Investments, written a lot of books. He's in Manhattan Beach. Anyway, that's our guest today. He's been written up by all the major periodicals, and anyway, I thought maybe you knew him. He's in California.
No, I didn't. I don't know him. I just looked at who he is, and it looks like he's going to be an amazing guest.
Yeah, he prepared a PowerPoint, so it should be a great interview.
Oh, right. Wow. Okay, great. Well, you guys
take it away.
So that's awesome, Dale. But no, I'm not familiar with him, but I just looked at him and I'm like, I've probably seen him on TV before.
Yeah, I'm losing your volume.
Blake, it's like you moved away from the microphone.
I shouldn't have. Can you hear me all right?
And now a little bit better.
I just put it on my head versus.
Okay.
Is this better right here?
Yes.
Yeah, you're good now.
Really? Okay.
Yeah. Yes.
Well. Okay. Hey, it's around my neck, and this is much more comfortable, so that's fine. Okay, thanks. Good. It's better than being on top of my head. So as long as you guys can hear me, okay, then that's fine. Thank you. All right, so let's talk about. Let's first and foremost go into the dollar and just let's talk about the breakdown that we're witnessing right now in the dollar index. The dollar index is breaking lower, and as you can see, we've cleared a lot of supports now. The real key level support is going to be down here around 93.50 roughly. I don't want to go to a week or a monthly chart, but let's go over to the weekly chart. This will be a multi-year trend line that comes in, and you see some horizontal support. It'll be down here around 93.50, and that looks like where we're going. So until we get there, you guys probably want to be on, just look to be on the short side of the dollar only really until that point. That's what would make most sense to me. So at this stage, if the dollar index rallied, then a move back up to 95.65 would be resistance. So 95.65 resistance. We are in a bearish trend. The next stopping point for the dollar is got to be this horizontal support, which will be right here at 94.70, roughly 94.70. Okay, so that's the dollar first and foremost. Now I'm going to take you over to the euro dollar, because I think the euro's equally important, what it did last night, because the euro dollar just continues to get blasted. We are at 161% extension of this. You guys can see it here, right? Of the flag. So we are there. Relative strength is overbought. So would I expect the euro to stall around here? Yeah, I would. That doesn't mean we're going to. I just am saying that I think it will stall around here. Hold on really quick. Let me do this. Never mind. If we continue higher, so what we should probably do is let's do this high to low here. Just see where the 127% extension comes in. 17. We're not going to make it up there today, I don't think. I'm going to start marking down some round numbers. When you have a runaway freight train like the dollar is right now, you got to start looking at round numbers. So I'll write down I'm going to write this down just so you guys have it here, 115.75, because that's where we're at. 116 would be the next resistance. Now support is 115. Period, end of story. And matter of fact, you could probably, let me put my asterisk there. You'll notice that the low overnight was 115.07. I had it, but just so you know, I had some buy orders below 115 just to try to get long on a dip below 115. Obviously, they didn't get triggered, but you can see this is the 115 level, right? It's a 115 spike high. We basically came down, probably a truck ton of buyers down there, and then just pole vaulted right up. So now any dip even close to 115 is going to find buyers now. Cable. So I bought the pound overnight. I bought it just ahead of this 38% retracement. We actually dipped to the 50% retracement. So as long as we're above 126.40, which here's your daily chart. There's your trend line, right? Okay. Broken trend line. We came down and retested it perfectly. So that means that 126.40. Oh, shoot. Is key support. This is bullish. Now the cable, while we're above that trend line, is bullish. I know it's struggling a little bit, and there's a lot of trade talk going on with the pound. Hold on, really quick. I'm going to. Let's see. I'm going to take off just a little bit of my cable from overnight. I took off a third of it because I bought it at, like I told you guys, I bought it at 126.80. So I just took off a little bit here for about 30 pips. Everybody that was in the chat room knew that I picked it up overnight. So the reason why we're coming right back to, you can see we're right back at support. So right through here, right? So I wanted to take a little bit off just to square up some. It's important not to be too super aggressive here, especially when you're in a currency pair that's an underperformer, when you have the euro up against some pretty key resistance. So anyway, the cable resistance right now is going to be the overnight highs at 127.60. I guess it was 65. I got out at 62 out of half of my position, which obviously is pretty much cherry picked that, which was lucky, more luck than anything. But I'm going to write that down as resistance, 127.65. That'll be you know, not really key resistance. This is key support though. Okay. Aussie, very strong. Now let's talk about where the Aussie's at. The Aussie, if you look at the highs from, dang it, the highs from 2018, right there, to the low, 618 retracement comes in roughly about 131.30 or 40. We're obviously above that right now, but when you're looking at weekly charts, you can overshoot support or resistance by 50 pips, and it really is not a big deal. Where we close on a weekly basis is going to be very important. Like if by the end of the week, if the Aussie closes back below 71 cents, that's going to be a pretty bearish event. Right now, the candle looks great. The weekly candle looks great. By the end of the week, it might look a little different. So don't get super excited that we're above this key resistance right now. It's really more important on how we close the week.
But Blake,
yes?
Sorry to interrupt. I don't know if you've noticed. If you zoom out to this chart, this level is, for an extra reason, important resistance. There is, if you go to the high of 2013, October 2013, and you draw a trend line from there, you will see that it passes through all the highs, including where we currently are, more or less. Not that one, the one lower from that.
Here?
The previous one, the exact previous one. Yes.
Hold on. Sorry, guys. I'm going to took off a little bit more cable here. All right. I'm sorry. I'm just, sometimes I got to do some trading. I'm just adjusting my stops now. That's 40 pips. I can't really, allow that to get away. Okay. Thanks, Steve. So we got a trend line coming in. Very good. We have the big weekly 618 retracements right around here. And if you go over to the daily chart, we're above the 127% extension of this triangle, which the 161% extension comes in at 72.45. That's going to be the resistance I'm going to have to write today, because we could make it up there. Not saying that we're going to, but you look what's happening with precious metals. And
Blake, you have a typo on cable. Sorry, it should be 127.
Yes, yes, thank you.
The resistance, right? No, 126 and.
Oh, that.
Yeah, undo that. Yeah.
Thank you.
We're gonna need a lot of dollar pressure to get there.
Is there resistance?
Okay, thank you.
There you go.
Got it. All right, got it. Okay, thank you. So 72.45. Let me get over to dyslexia kicking in the morning. So support at 70 on dips. I got to work through all this stuff. Let's go over to the Kiwi. Cup and handle pattern. I did take the I did take the Kiwi pattern and play off this morning. The reason why, because we are at 161% extension of this triangle. Now, obviously, we've continued higher, which the actual target still comes in at 70 or 67 cents, right? So 67.10 actually. So that's going to be ultimately 67.10. I took it off because I was a little worried about the Aussie, where it was at that moment. But the Kiwi, just continues to rip higher. Any dip back down to 66 cents is going to be support. I had bids in there at 66 cents to try to get filled. No dice. So this is bullish. This is bullish. Dollar Canadian. So the dollar Canadian finally broke down. And we broke through 135, which was really important support. We actually bounced right to, 134.80, which is actually the previous low there. So that's going to be key resistance, 134.85. 134.85. I'm still going to keep it in a range, guys, because believe it or not, the dollar Canadian's not bearish right now. I mean, it may be bearish near term, but if you look at what we've been doing the last couple months, we're just in a range. I actually expect what I am thinking is going to happen here is the dollar is eventually going to, you know, the strength is going to wean off a little bit, or excuse me, the dollar weakness is going to wean off a little bit. And then what will happen? You know what? I'm sorry. I'm going to do one thing here. I just took the rest of my cable off. I'll come back and revisit that a little bit later. So I'm out for 45 pips. Okay. So what was I going to say? Oh, so I think the dollar, you know, weakness will probably, you know, we'll get a bounce, and then what that'll do is that'll create a higher low in the dollar Canadian, or maybe an equivalent low. I think that's what's going to happen. I'm guessing, but I'm not trading the Canadian right now. I'm just not, because it's been underperforming. But the 78% retracement comes in at 133.98, so basically 134. So that seems to be where we're going. And you know, if you you know, I feel like I'm repeating myself, because if you actually look at the dollar Canadian and you look at the analysis for like, so we close below the 200-day moving average, and the 135 level will be resistance as we slide towards the 134 level next. You know, I mean, this is all written for you guys last night, but you know, for those of you that are not Forex Analytics subscribers, you're now seeing this for the first time. So let's go over to the dollar Mexican peso. So the dollar Mexican peso is actually holding its support, and surprisingly, I say surprisingly because I am surprised that this hasn't broken down yet. I am. What that does, in my opinion, it puts at risk the a topside move, you know, at some point. Now, I don't know if that's necessarily going to happen today, or might be a week from now, but we have to be on guard. So 2273 is resistance right now. Oops. Support is 2225. It's probably the same as yesterday. And we are range bound. Okay. Dollar Swiss. Dollar Swiss continues to get smashed. We are at 161% extension of this move, right? See it? That fib. It comes in at 93.13. End of day analysis. Close below 78% retracement new trend lows, which put the 93.03 level in play next. RSI is divergent. Yes, this is analysis that you got last night. So, but nothing's changed. You know, it's all the same stuff. Again, if you use Forex Analytics, you already knew that. So 93.03 support. We're in a bearish trend, and bearish trend. Resistance now is going to be 93.65. Okay, dollar yen. Now the dollar yen is still in a range. I actually thought with dollar weakness we'd actually get a breakdown in the dollar yen overnight. It didn't, and so we have to just reference this range. It's 107.50 to 106.60. That's it. Nothing to do here. I thought we would actually crack 106.60 last night. I had alarms set up to, you know, in case that happened, because I was going to take a trade through 106.50 to 106, but nothing doing. Okay, range, US dollar, Norwegian krona. We should be closing in, getting close to the 9. Well, now I'll just put 903 level. And 920 is resistance. 920, 9.03, bearish. Gold. A lot of people were looking at this wedge. Well, that didn't work. 1861. This is the 161% extension. So you got to be real careful up here. I'm going to write the overnight high as resistance is 1865. It doesn't make it bearish, but I think you got to be, it's going to be pretty key resistance right now for gold.
Blake, sorry to
Yep.
interrupt. Dollar Swiss. I can't remember the numbers, but one of them is wrong because the support is above resistance.
This is 9303. 9303, and this is.
Oh, you put them the other way around.
I put them on
Okay.
the wrong side.
Okay,
So
okay.
Thank you.
Thank you. Thank one of our friends who pointed it out.
No, thanks guys for doing that. I'm just trying to type quickly. You know, I used to do this bias chart literally in an hour for when I did the morning edge every day. But I try to do it kind of quickly because I want to give time for Stelios and Steve to analyze the markets, obviously, with Dale. So before our interview, so I'm trying. That's why when I try to go through it quickly, there's some typos. So let me go back to support here for gold. Support 1821, or let's just call it 1820. I mean, if we get a dip back to 1820, that's like you got to be long down there, right? If we do. So last but not least, S&P, which I'm gonna say we're bullish while above 3230. And resistance, well, the highs yesterday are still resistant, but I think the big resistance is going to be 127% extension at 33.10 or 11, whatever. Close. Okay, there you go. There's your bias chart. It's done. Finished. Finito. It's all yours. Steve, Stelios, pass it over to you guys. How you guys doing today, by the way?
Thank
mate,
you, Blake. Good morning. We had
Good.
some Canadian data, but it was.
Do we have some data?
Yep, but too
Well,
much.
you guys take it. You guys take over. It's all yours. Everybody, thanks for tuning in with me. But stick around. Obviously, I'm going to stick around for this interview. I'm going to be listening in because it sounds like a good interview today. So, Dale, good luck with that. Steve,
Thanks, buddy.
Stelios, it's all yours. And thanks everybody I'll see you in 4 hours on the daily roundup for those of you that are Forex Analytics subscribers. See you there.
Nice
Thank you,
trading
Blake.
and
Thank you,
pipping
Blake.
lately, Blake.
Thanks, dudes. See ya.
Dudes.
You
How
guys
doing,
too. You guys too.
We're the
Vibing.
dudes.
You two dudes. All of the dudes. Anyway.
So, the day's main mover again, gold and silver.
Ugh.
And,
Elio, there is a rumor going around that you change your mind and you're going to be buying a different car with the
No.
movement of silver during the past 3 days.
It was good, I tell you. And it's funny enough, it's when you see a move like this, like a breakout so strong, it's easy to say, oh, it's got to reverse, something's going to happen. And we saw this early European hours today. Silver was up, 6-7% overnight. And then European hours, it got slammed to, I want to say, only up 1.5 or 2%. And
they took a buck out of it. Yeah.
Yeah, one of our friends, Costas, said on Twitter, oh, I'm long from 1910, but I think there's going to be a flush now. And I replied to him, I said, look, this is, you see a lot of moves. When you see something this powerful, it means that 99% of the time there's going to be continuation. Yes, you might get a downtick. Nothing goes up in a straight line. DSI in silver is in the 90s now, so eventually there's going to be a correction. But this move is so powerful that really any kind of weakness you see, in my opinion, should be bought. And I said to him at the time, it's down $1 or even maybe a little bit more. I said to him, no, this is probably the dip that we're going to see. And, we're back up to...
We said it at low teens, which
Yes.
wasn't really controversial, that silver was extremely cheap. We said it at high teens, which still wasn't much of a controversial statement. I'm going to say now that silver is still cheap.
I agree. And people who have been asking me for a while, because, I've been long for a while, and I had to go through the March dip and kind of close my eyes and hope that it's going to be okay. And they were saying me, what do you think the levels are? And I said, look, the first one is at around 19 and a half or 20, somewhere there. That was the big breakout. The next one, 26, and then you're going up to.
It proved to be the big breakout from the squeeze,
Yes.
because the squeeze in essence gave validity to the breakout. I mean,
Yes.
It makes it now clear that it was the level to watch.
Yes, and I think the next level is around 26, and then you're looking at really towards the 40s. So obviously it will not go there in a straight line, and I have been taking some profits along the way, but I still have a pretty good position, and I'm running that. And at 26 I'm going to reevaluate.
Great hold, Stel.
Well,
it's easy to make a call, a little tougher to make the trade, and the toughest thing is to make a great hold, to be in a trade and be able to hold it. I know I'm a victim of first daylight syndrome.
Yeah, it's
many times,
it's easy to take profits. And I remember when I first started in my first trading job in London, a guy who trained me, a very experienced trader, he said, trading is very difficult because we're hardwired to do the opposite of what we should be doing.
That's
we're
correct.
hardwired to take profits early and to let losses run, and you should do the exact opposite thing. And it's very difficult to program yourself to do that. And people who can do that successfully, and you have an edge and you do it consistently, that's it. In the long run, you're going to be profitable.
Also, the other psychological problem, Stelio, is that we are also hardwired to try to find reversals all the time.
Yes.
Instead of following trends.
Yes. I mean, famously, Paul Tudor Jones said that he's made most of his money in reversals. I think it takes a very, very special kind of person to be able to call those. And he's obviously one of them. I'm sticking with this. As I said before, at 26, I'm going to reevaluate. If we drop, I'm going to look to add. Enough of that. It's for me, it's a no-brainer still. One of our friends yesterday was saying that, why are you still long silver? Oil is a much better proposition. Well, from yesterday's day, that's gone 10% the other way. Anyway, it is what it is. Markets are what they are. You're right, you're wrong. Nobody's right all the time. And, you just try to do the best you can, and manage your money. That's the main thing. Risk management is the most important thing, in my opinion. I don't do as many trades as other guys do, but I try to make them count. Gold and silver we've seen. The dollar, I think we were looking at the DXY before. If you look at the weekly chart, there's a big trend line, support trend line, which comes at around 94.40. I think that might be, and it's actually, let me tell you where it starts.
I'm assuming you're looking at something.
That spike low.
Starting from April 14.
Okay. Now
April 14.
I know
there you go. You have it.
about.
You have it.
This one.
Yeah. So we're getting there. We touched it a couple of times, and now
we're confluencing also with this horizontal support area, and with with the previous low. So quite a key area of support around these levels.
Yeah. And the main issue with the dollar, in my opinion, is still stocks. If stocks keep grinding higher, the dollar is going to keep grinding lower. And let's face it, this is what Trump wants. And going into November, I wouldn't be surprised if they just keep going like this. So the dollar slowly lower, equities slowly higher. And
there is a thing that comes in question, though. Is it going to be slowly lower?
Well, yeah.
Because it started going slowly lower. But I'm not really sure about how it's going to continue, Stelio.
Yeah, I agree. But being election year, you can expect everything. So the dollar, just keeps going. What else is happening? Equities are doing nothing today. Data-wise, we had some Canadian CPI came in stronger than expected.
Yeah, actually double the number expected month on month.
0.7 year on year against 0.3 expected. This is in line roughly with most major economies. We're seeing after these horrible numbers, we're starting to see a reversal, which makes sense because economies are open or opening. Obviously, the main question is what happens in the next 2 or 3 months when fall comes, and maybe we get more cases of the virus, maybe not, maybe there's a vaccine ready, who knows. But this is what we had from Canada. What else to say? Okay, we still have the White House. There are going to be negotiations on the new stimulus package. They're still not agreeing. So 1 trillion proposed by the Republicans. The Democrats, I think, want something like 4, and they're going to be negotiating.
Sure,
and,
4. Why not?
Yeah, 4,
I mean,
40, whatever.
Yeah, just put numbers there.
Yeah, so they're negotiating. They're going to find something for sure, some kind of compromise for both sides, and that's going to be that.
Didn't the Republican Party have like a segment called the Tea Party? Where did these guys go?
Good question.
I'm really wondering. I mean, they were playing tough, with Obama wanting to raise the debt ceiling by minuscule amounts in comparison to the numbers we're talking today, right?
Yeah. Yeah.
I mean, where did these guys go?
Yeah.
I don't know. I mean, politics really. It's just comedy material, really.
It's a game, and it's become a quite funny game, unfortunately, in the recent years. So what else? We had actually worth mentioning. There was more escalation between the US and China. I don't know if you heard. They closed the Chinese consulate in Houston. It was ordered to close. I don't know what the details were, but something to do with protecting American intellectual property.
There was some kind of a statement that it was like, let me find it.
But this is not going to be good for phase 1, phase 2, or phase whatever between the US and China. Although it's yet another piece in the chess puzzle, right? They in the chessboard. They're just gonna use everything on each side as negotiating tools, as always. But just worth mentioning that this happened as well. And also, talking about stocks, Tesla are reporting today after the close, and remember, they are due to be included in the S&P 500 index, but to be included, they have to be profitable. So they have to show a profit. And I don't know if you've been reading recently, apparently they're cutting prices in China, and financing or something like that has become really, really favorable. So basically they're doing everything they can to show sales and to make sales. So that's interesting because, a beat or a profit in Tesla, that's definitely going to send stocks higher for sure. And that's pretty much it. I don't have anything else to say.
Okay. Do they also have like Ernst & Young as wildcard?
Anderson Consulting. Sorry, Arthur Anderson. No, they're gone.
In all honesty, I'm just, it's one of the things I'm looking forward to when we start being able to look under the surface, in Tesla's books. At some point, it's going to happen. I mean, it's definitely going to be interesting, but it's not going to be the exception. I have to say that. So clearly, if somebody had to begin from somewhere, would be the fact that as we said before, this squeeze in silver is the real deal. I was monitoring this ascending channel. The fact that we've now blown through it. Not only now we've blown through the long-term descending channel, which was in essence keeping silver in a long-term consolidation. Clearly some type of a bottoming pattern there. But we've also now blown through this ascending channel, and usually you see these type of moves at the beginning of much, much larger moves. Now, I'm not advocating that somebody should be buying silver at 23 after having moved from 19 to 23 in 3 days, because there is clearly no risk reward. I'm not saying or implying that it can't keep moving for a couple more days. I mean, at this pace, but I'm clearly stating the obvious that there is no risk reward to buy it. So you'll have to hope and wait for a decent pullback, which, won't necessarily come. I think that there is a big part of the market participants that are just waking up to the reality that monetary metals were extremely cheap. Silver, to answer our friend Grigorio's question, which was why someone bother with silver and not stay in gold. Silver is like crypto, fake value, just hype. First of all, I have to seriously disagree with the statement. Second of all, the answer to where is the value is where was the value in being long gold when gold was at 130 ounces of silver, which was unprecedented. I mean, we were like at 30% higher than the all-time highs in relative valuation. So since they share some common characteristics, I would have to say that if you were okay in bothering doing that, and we had talked about that in the recent past, that there was absolutely no reason not to sell part of your gold and buy silver when it was trading closer to 130 ounces of silver, because it was clear that this ratio was unsustainable. So, even if somebody did that temporarily, they could just have jumped to silver, and why not, after such a move lower, you can jump back to gold, and suddenly you find yourself with a lot more gold in your hands. Now, does it, is it a higher beta instrument? Yeah. And here comes the answer to the question. Why? Because somebody might want, a portfolio of precious metals, and why not add some of the silver there? I mean, it's that when they, really perform well, it will overperform. So why not have some silver as well in that? I mean, you can have like, your allocation, whatever you deem a good allocation for precious metals. You might want to have like 2/3 gold and 1/3 silver. I see nothing wrong with that. So, I do think that it's absolutely okay. Just look at this. I mean, from 130 down to 80. A magnificent trade without even, leaving the ecosystem of monetary metals. Having said that, and with, silver clearly overperforming, still gold is also pushing new highs. Tested this ascending channel trend line resistance earlier today. So far, it seems to be stalling here, but I don't really see any other resistance all the way up to the 1920 all-time high. And if you remember, we kept saying since months and months ago that gold was at all-time highs against almost every currency on the planet, and somebody had absolutely no reason to believe that the turn of the dollar wouldn't come. So I still believe that there is an extremely high probability that we're going to see new all-time highs against the dollar, and I actually believe that during this bull cycle for precious metals, I think we can actually see much higher levels than 1920, because I remind you that the previous time that gold topped, which was in September 2011 at 1920, it in essence finished a bull trend that began at, 680 something in 2008. So it had already moved in 3 years from less than 700 to 1920. So almost tripled in a period of roughly 3 years. But that's not the case anymore. I mean, if gold wants to pull off an equivalent move, which, considering the way we're printing money on the planet, it would make sense. I think we're still at probably an earlier phase of this bull run than at a later stage. Of course, nothing moves in a straight line. There's going to be pullbacks. But as I've kept saying day in and day out, don't try to find the pullback. Just buy whatever pullback you find. I'm assuming that by now you've realized the dangers of trying to fade monetary metals when on the daily headlines you see things like, oh, they want to pass a new stimulus package solely funded by the printing press. One party wants 1 trillion, the other party wants 4 trillion. They're going to settle, let's say, at 2 trillion. I mean, are we serious? We're talking about trillions and trillions of printed money. I mean, how is it possible for them not to affect, whatever has intrinsic value, and most importantly, of course, monetary metals? So, it is what it is. As I've said multiple times, this is the best environment anybody could ever imagine for monetary metals. Why would you want to fade them? In any case, as I said, resistance here in gold. Silver is out of this planet at the moment. I mean, we're already at 88 daily RSI. It's not easy to say. Next upside resistance is the 161.8% Fib extension of this move lower that happened along with the sell-off in equities, which comes at 2370, and above that there is a resistance area at roughly $25. Now, anywhere from there, we should see some type of a pullback. In such a market, it might even be a sharp pullback, right? And a lot of people, because these rallies are hated, are going to start calling, for like, oh, this is it. That's it. That was the end of the move. It was a bull trap. It was an explosive move, meant to trap people in the wrong side of the market, blah, 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 blah. But I'm going to be buying it, nevertheless. Steve, can you take a look at Cadien? Yeah, we had a look at it yesterday, and then I will, but let me take the questions one at a time. So, Euro USD, clearly has broken above this channel. You can see here the similarity between silver and euro, right? I mean, both of them were trapped in a long term. Of course, in the case of silver, it was much longer term, like slightly descending channel. We broke through it. We remain very well bid. I think that this area should be supported from this point on. So like 113, closer to 114 should act as support, even when retested. And the next real upside resistance, I think, is at 118, and I don't see any reason why we won't get there. Same deal here with cable. Cable was heavily sold earlier today, but the only thing it managed to do is retest the broken triangles, trend line resistance, which acted in this case as support. It's now almost unchanged on the day. I still don't see any reason why it won't retest the previous high here, and most likely this longer term descending channel. I took profits on my long position in the Aussie, and the pattern play has closed. The reason I did so, Blake showed it, so I'm not going to focus so much on it, is because we have multiple resistances here. Add to that the fact that very frequently triangles are terminal formations, meaning they produce one more move in the direction of the previous trend before we can see a deeper corrective move lower. So I would expect that something like this is likely, or perhaps from a little bit higher, 72, 80, another area of resistance. That's why I actually took profits. I mean, this was like a shorter term trade. It worked out quite nicely. I had a full position on it. I'm still short USD NOK and Euro NOK. I'm still short the indices though, and I've been bleeding my profits from months ago when I was long. But I'm still in the camp that stock indices should sooner rather than later suffer a deep correction lower. Now, the chances are clearly tilted in the direction that it's going to be a corrective move, because we've seen now what game they're trying to play, and they're going to support asset prices no matter what is needed. I mean, I'm pretty convinced that if needed, they're going to start making SPVs to even buy stocks. So I do think that stock indices should suffer lower, perhaps can be a 10-15% move lower even. But I do think they're going to step in once again. So, I'm still short. And if this works out, I intend to take profits on the short side. And I actually probably intend to buy some following that. I mean, I was long, then I shifted to short. If this works out, I'm going to shift to long again. Not because I think there is any fundamental value, but I think that they're going to keep inflating this bubble as long as they can, at least until we get to the elections. Now, will they be able to do so? It depends, because from a fundamental perspective, there are so many headwinds which for the time being the market ignores, but you know how it is. The market can ignore them until it stops ignoring them, and then they start mattering again. But in any case, there is more than clear evidence that they will sacrifice the dollar or whatever else is needed to keep stocks afloat. Now that the retail crowd has also jumped in, might buy some more time by fueling, this last phase of the mania before we have the day of reckoning, which might be months or even, who knows, a couple of years away. Question: how long did you take you to develop this type of patience and conviction? Very impressive to see how you and Stelios can stay with trades even if they go against you in the short term. It looks like. Let me tell you something. My let's say my previous boss in the fund I was working in, he was even better at this. But I'll tell you from experience that everybody's sweating at some point. You know what I mean? The only thing that can keep you in check is repeating correct behaviors again and again, so you gain more conviction by seeing that it works long term. And the second and equally important element is not putting on the table more than you can afford to lose. Because no matter what kind of a mentality you have, unless you are, crazy, which eventually is going to, lead to your demise because you're going to definitely blow up. By crazy, I mean, have complete ignorance of any type of, fear or, whatever. If you have on the table more money than you can afford losing, I don't think you can keep your calm. So it's all about not over leveraging yourself. I think these are the two elements that are needed. And trust me, even if you do those two, there's going to be days that you wake up and you're in a bad mood because your trades are working against you, and you might still be within your risk parameters, but it still bothers you. But you learn to live with it. I mean, yeah, it is what it is. You live with it because you know that there are other days that you wake up and you are in an excellent mood. I mean, Stelios was long silver, and I mean he's doubled his money in essence. So guess what? He's waking up with a smile. So if you don't
Steve,
go through the bad.
Steve, I've been looking for our guest. I'm hoping he's not on a Chromebook. Is that you, Meb, on a Chromebook? Or if you could just put something into the chat so I could find you.
Why did you mention Chromebook? What's the problem with a Chromebook?
I have one phone call in listener on Chromebook. I'm hoping that's not Meb, because
let me have a
microphone. It'd be my bad to tell him that you needed a mic, because
He
call-ins
has
don't work.
Chromebook, it should have a microphone.
Okay, well, I'm trying to find out if that's him. Calling Mebin Faber. If you're here,
one phone call listener. I see it. Yes.
if you could just chat something. in the webinar chat.
Yeah. Okay. He
Go
should
ahead,
let us
Steve.
know,
I
and
will.
he should log in with computer audio, because when you log in initially, there is a question if you want to participate with computer audio or via
Yeah.
telephone. But via telephone, the only problem is that you can.
You can't. There's no mic to be a guest. We've tried it before.
We can actually allow him to talk if we want to.
Okay. Maybe
There isn't
that's him.
allowed-
It is time for the interview. I'm just
Okay,
not
let me unmute him and see how that works.
And you become consistent. And you consistently, week after week after week, capture this 378 pips. And you do that for 12 months straight.
That was the
Who's
guy.
that?
Just muted him again.
Who's that?
I don't know. It was the phone call. I unmuted it, and there was somebody talking about what you heard.
Yeah. Okay.
Okay.
I
Until
hope-
you have
I hope
news,
that's not
we have
him.
things to discuss here. So
Go
just
ahead.
keep me in the loop.
All right.
Okay. So going back to the question, Silver Crazy Move, Silver 50 in the 80s. Yeah, actually. It was the Hunt brothers that tried to corner the market. What I remember from this story, I think it was early 80s. What I remember from this story
79.
was, no, I'm pretty sure that the high was within the 80s. They might
Well,
have
then
started.
it was the beginning of 1980 when
Might be.
Russia went into Afghanistan.
Might be the case. Might be the case. But I do remember it was in the 80s, and I do remember from this story the following impressive fact. They
Okay, Meb is
owned,
here.
they ended up owning, Dale, 1/3 of the global supply of silver. If you
Yeah,
can,
and
if-
then
if
the
you can
exchange
imagine that.
changed the rules to
Yeah.
liquidation only.
Yeah, if you can imagine that, owning 1/3 of the global supply.
Yeah, I used to, but I just couldn't schlep it around anymore.
You
Yeah,
sold it
it's
all
just
at, you sold it all at $11, right?
I got out March 23rd. All right,
Okay, so your
so,
guest is here, right?
Yeah, Meb is here.
Okay.
Okay, thank you.
Enjoy.
Oh, look, Richard remembers. All right. Oh, that's not what I wanted. Hi, Meb. Welcome to Face.
Hey guys, good morning. How do you do?
Good morning.
Thank you for getting up with the rooster.
Sure, no problem.
Meb's on the West Coast too, so we're watching a beautiful sunrise here in California, COVID capital of the world. So, Meb, really nice to meet you. I went over your website. Do you want to share your screen, or would you prefer that I share your PowerPoint? Up to you.
Either way, you're probably at the controls, so maybe easier if you did it.
Okay, I'll share my screen. Okay. So, why don't we start off with about Meb Faber, and there you are, buddy, and welcome to the Southern California lifestyle. How long have you been here?
Well, I'm actually dialing in from Colorado.
Oh, okay.
Once they closed the beaches again,
Yeah.
I had to get out of town. We got a lot of family here in the mountains, so
Oh, nice.
spending a few weeks on a road trip across the U.S. like I think a lot of other people. I've been on the West Coast since early 2000s. Was up originally in NorCal, Tahoe, and moved down to Los Angeles, Manhattan Beach,
Yeah.
for a year to try it out. That would have been in about 2004, 2005, and that 1 year has turned into 15.
Yeah.
So
Is this
it's
a
been
picture of
great
you on the
place.
beach that I'm showing right here?
It's not, but it's not too
Okay.
far away. It's
All right. Well,
it's despite the taxes and everything else, there's a reason
let
why
me
so many
ask you
people
this.
want to live there.
I have an expression that great surfers don't try and catch every wave, like great traders, great surfers don't try and catch every wave. You see some parallels in surfing to being in the markets?
I see a lot of parallels, but mine comes from kind of the opposite angle because by no means am I a great surfer. Growing up in Colorado and North Carolina, I'm a fairly terrible surfer. I'm a good skier. I'm a terrible surfer. So for me, the parallel is more the humbling nature of it, where
Yes.
just when you think you're hot stuff, the markets have a way of taking you out behind the woodshed. And the same thing is true about the ocean, of course, where there's no more humbling force than that of Mother Nature. So
Purling on
slightly
purling
different
on a
angle.
beach break. I tried to learn at 40 when I moved out here. So
Yeah.
I did the wave, all I'd have is air under me when the wave was breaking. Anyway, I gave it up. So I want to just start moving through your PowerPoint, and it looks like it's pretty much based upon how now brown cow after COVID and the crash, and here we are. So you could see my screen, right, Meb?
Yeah.
Okay, so let's go to the next slide.
Sure. And
Go ahead.
if there's any way to make the slides a little bigger on presenter view or anything, that may make it easier for people to see it. But if not, it's fine.
Okay.
So, where to begin? As people look around the world here in mid 2020, it's been the dawn of a new decade, which is somewhat amazing because we're only 6 months in, and it feels like
decade.
an entire decade has passed already.
Yeah.
But we had remarked kind of at the end of last year that subjectively speaking, decades often have a way of marking large turning points in society, but also markets. If you look back in history, many of us, the older crowd or the historians can recall plenty of decade ends where markets had pretty big inflection points. Obviously the people can remember the financial crash of global financial crisis of 10 years ago. Prior to that, of course, the internet bubble. When I first moved to San Francisco, right at the very peak of it. And then 10 years prior to that was the biggest stock bubble we've ever seen, which was Japan, and on and on. And so I jokingly said at the end of the year, I wonder what 2020 decade will have in store for us. What will mark this? And it only took about 1 month in before we started to figure that out. But, a lot of the forces at play, and I'm talking a little longer term here, have been in play for a while. And, the thing that most people like to start with, which is what kind of I'm bringing up here, is what's near and dear to most of us here in the US is stocks. And stocks ended the decade. We said December 31st, have a glass of champagne, have a beer, toast your loved ones, pat yourself on the back, because it was an exceptional decade for stocks. And what we said with that cartoon graphic that you saw was that the challenge is that the good often precedes the bad, to say it extremely technical,
Yin-yang.
and vice versa. The good times set the stage for more somber times, and on the opposite side, nothing really lasts forever in markets. And so it was one of the best performing decades, but that meant by the end of the decade, stocks had gotten pretty expensive. They'd started the decade cheap and ended pretty expensive.
Is that your Uber driver there looking in the rear view?
Exactly.
Okay.
So, this graphic I think is meant to be humorous, but a lot of people in markets, one of the biggest mistakes is they try to extrapolate, what's happened in the past to the future in a way that, I think can be dangerous. And so, for those that are familiar with my work and our company, we have two main pillars that we spend a lot of time that build a foundation. On one side, it's momentum and trend and sort of price-based variables, and on the others, it's fundamentals like value. And so, if you were to put stock valuations into context, and this goes back over 100 years, we didn't invent this metric. Professor Bob Shiller wrote about in the 90s, but then it's based on stuff from Ben Graham writing 100 years ago about taking price earnings ratios for individual security, instead of doing 1 year, Ben Graham talked about 5 to 7. Shiller said, let's round it out to 10. And in this case, applied it to the entire stock market and found that, lo and behold, the average valuation was around 16, 17. But there was times when it got to 20, 30, 40. The dot-com bubble was the highest it's ever been at 45. There's times it's down around 5. So it's been somewhat this crazy indicator, but the high ratings usually preceded low returns, low ratings preceded high returns. And so where are we now? We're at a value of about 30. It peaked maybe about a year ago at around 33, but this year has seen a lot of movement both down and back up. But again, a decade ago it was cheap. So
Okay.
if you move to the next slide, let's take a drive. We passed Vegas on the way to Colorado. It was crazy. It was kind of a ghost town on the Strip, nothing open. But if you were to go to Vegas when it was open and play blackjack and sat down at a table and you're a tourist, you're sitting next to a tourist and, he's got 19 and the dealer has 6. That's a pretty good hand. But he says, hit me. And you're like, what are you doing? That's so crazy. I can't believe it. And he says, shut up. You don't know what you're talking about. And he gets a 2, right? Makes 21. You say, well, look, it worked out, but it was not a sound decision in the beginning. And that's kind of how you need to think about markets, is that you can come up with a fairly decent approximation. And this table is not mine. It's actually John Bogle's. He wrote a formula in the 90s, founder of Vanguard, right?
Yeah.
Where he said,
he was really one of the best guys that, I saw him, remain calm during major drawdowns in the market and was, Mr. Long Term. Wouldn't you say?
He's probably done more for individual investors and institutions too than almost anyone on the planet. And RIP, John passed away last year. And by the way, I have a tendency to just blab on, so interrupt me at any point.
Okay, man.
So
I'm known to interrupt. See?
Yeah, good. So he came up with this formula and he said, look, and he would never frame it as forecasting, but rather just to frame expectations, where he said, you can come up with a pretty good idea what stocks will do the next 10 years by 3 variables: starting dividend yield, then your dividend or earnings growth. Usually they tend to be roughly the same. And lastly, change in valuation. And he's like, that explains all the stock returns for the past 100 years or so. And it's incredibly accurate if you plug those numbers in. Now, of course, the problem is we don't know what earnings growth and valuations will be 10 years hence. But if you just plug in the historical for earnings yield earnings growth and dividend growth, then you can run through the scenarios on what happens with valuation. And so right now we got this 2% dividend yield, which historically is pretty low. There's reasons for that. We could get into probably if we had
central planning.
2, 3, 4, 5 hours, but we'll just move on.
Okay.
We know what the starting valuation is today. It's around 30. And the question is, 10 years from now, what will valuation be? Will it be flat? Will it be up? And if you're at blackjack table, the most likely scenario is that valuations drift back down to, quote, sort of normal ranges. Now, normal historically, I said down around 17, but if you have low inflation like we do now, you mentioned central banks, people pay a higher multiple. So call it low 20s.
Why don't we talk about that a little bit, Beb? The low inflation. You have headlines. People buy headlines today, sell newspapers tomorrow. But you have headlines in the precious metal complex. Grains are starting to look good. Industrial metals are looking good. Is it possible that what we're seeing and what we see in the grocery store since COVID and the supply chain issues, that we're going to have to factor in more inflation than the market is currently expecting, in your view?
Well, I love that, because you just mentioned a few areas that have been left for dead for the past decade. You know, commodities in general.
I think the ratio's at a historic low. Stocks.
Yeah,
versus
they had a really
commodities.
tough
Yeah.
decade, and you know, we consistently and have for a long time, you know, mentioned that there's really three main buckets that all investors need to consider in a balanced portfolio. It's global stocks, global bonds, and global real assets, in which we include real estate and commodities. And as you mentioned, they've started to perk up, first with gold, now with silver this morning. I have my family comes from a long line of farmers. And so it's very painful for you to mention the ag prices, because I'm very well aware the prices of wheat and corn and how they've been.
But when I
fairly low
started,
for-
Meb, these are good prices. I mean, you know, when
Mhm.
I was started in the late 70s, you had $2 a bushel corn, you had $3 wheat, you had
Yeah,
$5 beans. I mean,
Yeah.
they've all doubled, and these are still not good prices for farmers. I have to think it's because of the cost of production, because prices, at least in nominal terms, have increased over the last 20, 30 years. I mean, remember the
Yeah.
old mantra, beans in the teens? We even accomplished
Yeah,
that
well,
several years ago.
I think
Yeah.
the inflation does play, you know, a factor, and it is the big long-term risk for most portfolios, which is why you want a lot of the elements that, you know, kind of we talk about that help to protect against that. You know, being a market analyst and historian, you have to prepare for any environment.
Right.
And we wrote about this actually back in March about coronavirus, which we can get into. But you know, in the inflationary concept, you also have to at least consider the possibility of deflation. I mean, we live in a world where most sovereign bonds around the world actually trade at negative values, and it's hard to conceptualize and believe that's possible in the United States, but we're down around 60 basis points on the 10-year, and it's not that far away. They didn't teach that in the textbooks when I was growing up.
No.
It's at least a possibility that I think people have to consider. And so,
Were you a little surprised, since you brought up the 10-year, Meb, that with the huge recovery we had in S&Ps from 2,200 to 3,200, that we didn't get any pop, hardly at all, in yields during that whole time frame?
so I like to say I'm always surprised and never surprised. I mean, every day with markets, you know, it
Yeah.
makes it our job interesting. But the number one thing that we tell people that they have to do if they want to become, you know, serious investors and traders is become a student of history, and you know, to realize that crazy stuff happens all the time, and at least be able to at least consider all the possibilities, how rare or crazy, like oil futures trading at negative values, like
Never would have
a pan-
imagined. Yeah.
right, like a pandemic occurring. And so one last comment on that table, and then we'll move on, is
Okay.
that so you at least have to consider the possibilities. And so, you know, could valuations trade back down to 5 in US stocks? That's happened before. Yes. Could they trade up to 45? That's what we saw in the internet bubble. Yes. The most likely scenario is they drift back down to average for stocks, which means next 10 years stocks should have low single digit returns. That's not exciting. It's not, you know, it's saying they have to go down 10% a year and they have to crash, but it just means they're going to be more muted. The problem is most investors, survey after survey, expect 10% a year in returns. So they're getting set up to be disappointed. And it's a kind of,
Pension
a
funds
doctor
need
would say,
7.
take your medicine.
Yeah, pension funds need 7, don't they, Meb? That's going to be a
Yeah,
problem
and
for them, isn't it?
we wrote a paper about this years ago called Pension Funds Investing, Fingers Crossed and Eyes Closed. And, you know, most of them know darn well that in a world where, let's say US stocks, I'm going to be generous, let's say they're going to return 4% for the next decade, and bonds, you know what you're going to get with bonds. Let's be super duper 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 generous and call it 2%, which of course is not where they are, but
Right.
you can't even add 4 and 2% together to get 7,
Right.
because that's not how it works either. There's no combination of those two assets, and so the pension funds, you know, have started to move into other ideas that I think are really going to set them up for trouble. That could be one of the largest societal issues over the next decade.
Yeah.
I think will be a lot of the pension problems, but that's
Anyway,
a
I
whole
just
nother rabbit
wanted
hole.
I wanted to brush on it, and just so people know that there are other things besides COVID out there,
And
right?
so, but I think it's important when you talk about expectations, because if you say, look, my base case is stocks at 4, bonds at 2, I need to adjust my expectations and lifestyle to account for that. Save more, spend less. That's good advice for almost any time. Or you can also start to say, are there other assets that will be complementary or do better than 4 and 2? And that kind of leads to the next slide or two, which
Yeah.
is most
There are
Americans.
the globe is a big place. Not just
Most
North
Americans
America.
don't have a passport. I think it's right around half.
Yeah.
A lot of people.
Well, we can't use them now anyway.
I know.
Go ahead.
Most people think in terms of their own worldview, and like this chart says, that if you were to buy the global stock market, the U.S. this used to be half, now it's 58%. But this waxes and wanes over time. Like I mentioned, in the 80s, Japan was the world's largest stock market. But if you were just to follow our prior mentioned Jack Bogle, if you were to go out and buy the world, this is what it looks like. But if you look at the next slide, the problem is nobody does that. And what everyone does is something really stupid, which, as we call this, home country bias, where they put all their money into their own stock market. And it's not as bad in the US because we're the biggest, but our friends in Italy, Australia, Japan, all the way down, every single country does it, where they put like 50, 60, 70, 80%. US, the average is 80%, by the way.
They buy what they know.
You buy what they know because it feels comfortable. It's a false sense of security. And it ends up being a really bad idea because you have this massive, massive concentration. And that the next chart's actually from Vanguard, showing that people put all their money. Now, it's been look, pat yourself on the back if you've done it in the US the past 10 years. God bless you. You've crushed it. Ask any other country in the world. Ask our friends in Brazil, Greece, Russia, all the way down. Was it smart to put all your money in one stock market? And they would say, absolutely not. That's crazy. So having a diversified global view, I think, is very thoughtful.
Well, we have a recent development here. I mean, it's kind of been turning, like, it takes time to turn a battleship around. But there's been some pretty good weakness in the dollar and euro making new highs. Is that part of your thesis for being in emerging markets?
Now we're on to currencies. I know is something y'all talk about, and on the long time horizon, currencies tend to balance themselves out for inflation, and on a real basis are fairly stable over time. But over the time frames of 1, 2, 3, 4 years, they can obviously go up, down 50%. I have kind of two comments. One is that, in equities, I'm agnostic. If you've been listening long enough to this podcast, that, or webinar, that I have very strongly held opinions about some things, and about some things, I don't. And currencies,
you don't.
If you're going to do stocks, you can either hedge or not. I don't really care, but you need to have some sort of approach. I think flipping back and forth, unless you have a trading system or a style, I don't care if it's valuation or trend or whatever it may be, as long as you stay consistent. But yes, it does seem like after a long period of strength that the US dollar is starting to show some cracks, and we'll see if that develops anymore. I think currency hedging makes a lot more sense if you're a bond investor, because it introduces a lot of volatility that bonds don't necessarily have. But again, these are not strongongly held beliefs in either case. If you were to tell me do one or the other, I'd say currencies are really confusing for investors, by the way. I think it's hard for investors to think in terms of
I'm confused
particularly
right
in the US.
now. Yeah.
What's that?
So I can relate to confusion. So, okay. So we're looking at this, and you're a believer in diversifying around the globe. Any areas that you like?
So let's go
outside of
down a
US?
couple slides. There's a chart of valuations, and this one
This
to
one?
me, yeah. And we wrote a piece recently, and I've been banging this drum for a couple years. Is that I said it's the biggest valuation spread in 40 years, and this chart is
Oh yeah.
a demonstration of the former CAPE ratio we discussed, so 10-year price earnings ratio on the U.S. stock market. That's the blue.
Right.
And then the red is the world outside the US. And one of the biggest arguments, we hear a lot of arguments, by the way, about why you should put all your money in US stocks. People say that there's the familiarity, there's the rule of law and stable politics, which I always laugh at. If you talk to anyone outside the US, it's always a funny conversation. But one is people say, no, US stocks deserve to have a higher valuation. They always have. Why would I go invest in these other countries? They deserve to be lower valuation. And to which I usually ask my friends, I say, okay, if the US has a higher valuation, so the US is around 30, the rest of the world's probably half of that. I say, what's the historical premium? And they come up with a number, and I say, well, because the answer, the historical premium is zero. For the last, 40 plus years, the valuation of both US and foreign markets, the CAPE ratio has been 22. And it's sometimes the US is more expensive. So you can see here that now in the late 90s, but sometimes it's cheaper. For the entire 80s, when we mentioned that Japan was booming and the US was struggling, Japan got to the highest valuation we've ever seen for a stock market. It hit a CAPE ratio of almost 100, which is incredible to think about. With the US is at 30 now, it means it needs to triple to get to that.
But even back then, we had a mean reversion back to equality after the Nikkei bubble popped.
Yeah.
And so is your narrative here that there's some type of mean reversion? How do we get there with US stocks being flat to weak and emerging markets outperforming during this time frame where they may meet and merge again? These valuations.
There's a
these
number of different
differentials?
pathways, and if you were to ask me at the beginning of 2020, I certainly wouldn't have outlined the one that we've taken this year to date. If you go back in history and put stock markets into a quadrant of, are they cheap? Are they expensive? Are they in a downtrend or are they in an uptrend? And you can use any trend indicator, but like a long-term moving average. Historically, the best performing box you want to be in is cheap uptrend. The second best performing box, and the worst, is expensive downtrend. And so that makes sense. The second best performing box is expensive uptrend, though, which is where we are now. But when that flips to expensive downtrend is usually when there's a lot of pain. So there's a million different future pathways. The US doesn't have to crash. It could simply do 4% a year while foreign developed and emerging does 10, for a decade. That has a way of rectifying the valuation. But this is a summary. US is around 30, foreign developed is and this is average for countries, not market cap weighted. Foreign developed is totally reasonable. These numbers have obviously bounced around all over the place this year. Foreign emerging, we're on record thinking is pretty screaming cheap. And the cheapest bucket, which is if you look at 45 developed and emerging market countries, and we track all these valuation ratios. And by the way, listeners that are probably pulling their hair out about CAPE ratio, valuation metric doesn't matter at all. You could use dividends, you could use earnings. In the US, the value line median PE is the highest it's ever been. They all should say the same thing when they're at extremes. And valuation is a very blunt tool. If you're doing it to 2 decimal points, you're doing it wrong. And also at the time horizon, it's a decade. It's not next month, quarter, even year, but it plays out over the next decade. So the cheapest bucket is down around 10. So you say, look, these countries may very well.
Give us a few countries that would be in the cheapest.
All right, let's see. Let's test all of our listeners' geography skills. And it's early for me, so I may not be able to even identify all these. No, so Argentina's funny because Argentina kind of jumps in and out of developed emerging frontier status, depending on their crisis. They
Depending
seem to
upon
be always,
if they're in default again or not.
yeah.
Oh.
That's too painful for me to
All
even
right.
think about. We've owned
Okay.
Argentine bonds at some points over the years, but
Yeah.
so look, these this is the challenge: is that value investing often means you buy simply what's down the most already. So if you do a correlation of buying the cheapest stuff, the P and the PE is what drives it. It's not the earnings usually. It's just that the price has already gone down 40, 60, 80, 90% is why the PE is so cheap. And then usually when the PE is expensive, it's simply because the price has gone up, like the US. So these 5 countries, let's see, I think it's Czech Republic, Poland, Spain, Russia, and Colombia, which is like a who's who of places no one ever wants to invest. But in Q1, by the way, many countries got into single digit PE ratios. Some of these are at like 5, 6, 7. And so, are their economies thrumming? Is everything going well? No. I mean, in many of these, there's some were going through their own Great Depressions. Unemployment is double ours, really struggling. But how much of that margin of safety is built in? And so with valuation historically, it's not just about buying the cheap stuff. It's also about avoiding the really expensive. The good news is most of the world, we have the US as being the second most expensive market. Most of the world's not crazy expensive. And the US isn't even that crazy expensive. It's just expensive.
Okay.
And so anyway, these countries, I think, have a lot of opportunity. When the value and momentum start to align, that's really when you see the potential explosive returns. And that's kind of been back and forth over the past handful of years. We'll see when that ever happens. But if you had to split it out by development status, emerging value would certainly be our pick. Now, one last comment. Each market, by the way, is not just one market. If you look at the US, you can break it up by size, large cap, small cap. You can break it up by valuation. Sometimes they look different. Sometimes they look similar. Q1, small caps, and particularly small cap value, got absolutely destroyed. It was down 50% at one point.
Yeah.
Listeners that own those stocks can probably relate. So the spread between the large cap growth, the Teslas, the Facebooks, the Amazons, and the small cap value blew out this year. So if you're going to do the US, we say, look into sort of small cap value. But if you're going to do global, think certainly beyond our shores.
Okay, let me ask you this, Matt. We're only about 3-4 months away from a presidential election and U.S. elections in general. Did that fit into your narrative, and the market seeing it as things I've read is that market's not going to be that upset if there's a Joe Biden presidency as long as the Senate doesn't flip. Does it work into your analysis, and are there ever times when it's okay to be in cash and not always fully invested?
Oh, you got a bunch in there. Okay, so let's unpack each one at a time. I'm a quant, and I think it's important. I don't care if most investors are quants or they're discretionary, but it's always important to at least have a plan. And we encourage all of our investors. We have over 40,000. We say, look, write down your plan, just like as if you're tackling an exercise regime. Share it with your significant other, your children, or your partner, and your neighbor, whatever, to keep you accountable. Because if you don't have a plan and you go open the refrigerator at midnight, you're probably going to take the ice cream out. If you don't have a plan in markets and you wake up think back to March, when markets were down 8%, the futures were hitting limits every which way, you're probably going to do something stupid. So having a plan is probably one of the most important things, whatever that plan may be. You may be, look, I'm a dividend guy, I'm a 60-40, I'm a trend follower, I'm a technical sport, whatever. It doesn't even matter.
Many ways to skin a cat, right?
Yeah, as long as you have some sort of foundation from which to not shoot yourself in the foot, which is what we see so much, behaviorally speaking, with investors. And we still talk to investors that got out of stocks in 2009 and never bought back in. So having cash, by the way, totally acceptable investment and asset class. Now, whether that's 5% or 50, we don't think it really matters. We actually did an article. We did a big series this year called the Get Rich Portfolio, the Stay Rich Portfolio, investing in a time of coronavirus, and how I invest my money, because I disclose very transparently what I do with my own money. But in that, the Stay Rich Portfolio, it talked about the role of cash and its importance. You know, it gives you optionality, it gives you sleep at night. But over long-term horizons, you know, because of going back to what you mentioned in the beginning of inflation, you have to have some growth type of assets in there, because cash on a real basis after inflation is just as risky as a lot of other investments. People just don't see it because it's a slow bleed. So you need to, a safer portfolio is actually blending cash with stocks and real assets too. So we always tell people cash is a totally acceptable decision. Now, going back to elections, you know, this is where you grab your beer or coffee. It's
you
early
don't
enough.
invest around it. It's
You
cocktail chatter. Huh?
So, but it's fun and it's interesting. And I'll give you 2 points. One, as we said, back to the prior election, I said that the outcome of this election is totally meaningless. This won't be popular. Markets will do what they may. And I said, however, you can forecast the election with about 80% certainty, and that's based on the stock market. And is the market up? And you can use, I think, a couple different variables, but one, there's a white paper that showed the 3 months going into the election. So right now, starting today, essentially until election time, if the market's up, the incumbent party wins like 85% of the time.
Right.
And if the market's down, they lose. And so that correctly, again, predicted the last election. And so you better believe that the powers in office are going to want to see the stock market up over the next few months to the extent that they can explain that narrative. Now, whether or not the impact of the election impacts stocks the way that most people believe, you know, markets tend to be forward looking. And when the election happened last time, I was tweeting because the markets were crashing. If you recall, after Trump started winning, the futures were down big that night.
Limit down till Carl Icahn went home to buy.
Yeah. Zero people would have predicted for the first time in history that the stock market went up every single month in a calendar year. That's never happened before. It happened after the last election. I think the market was up like something like 16 months in a row. It was a record. So again, we always joke that when a lot of advisors write letters, they write advisors like, it's okay, clients, this has happened before when something crazy happens in markets. But we always say what they should be writing, because something will surprise us, is, okay, clients, this has never happened before. So we'll always be surprised. Now, the betting markets are favoring Biden right now. Trump, I think, is at plus 150 versus Biden, but who knows? I think in general, the party in power, it's more cocktail chatter than impact on investments.
Okay.
But I don't know.
Very interesting having a conversation with you, and your demeanor, Meb. Your DNA was suited for this. You have a very calm demeanor. Accomplished. The best way for listeners, viewers to follow you. You do anything for the retail trader, or you mainly just dealing with institutional clients?
No, so my day job, and thank you for having me today. This has been so much fun. We need like 2 or 3 more hours. My day job is I'm the founder and CIO of a asset management company called Cambria. We manage 11 ETFs, and they are mostly quantitative based. It's everything from asset allocation funds to very specific niche products. Our largest is actually a tail risk fund, but things like global value and sovereign bonds, we do a little bit of all of it. And the big difference between us, I think, in a lot of traditional shops is I put all my money into our funds. The average mutual fund manager actually has nothing invested in his own fund, which is a really unfortunate, state of affairs. And so Cambria Investments, which is where you are, by the way, you can go download most of our books for free. So go check those out. I would start with Global Asset Allocation if you're new to us. But you mentioned Carl Icahn. He's on one of the covers for one of our books. But
Yeah,
those are
this
all
one?
free. The Invest with the House. Yeah, but
Yeah.
GAA is the one I would start with, I think.
Okay. I really want to
But
thank you,
yeah, we
Meb.
have over 40,000 investors, so it's
Yeah.
it's not just institutions, it's people all over the world.
Thanks for making time for us, Meb. Really glad that I reached out to you, and like it or not, you're now my trading warrior brother.
Yeah, and I look forward when the world goes back to normal, hanging out in person in California or wherever we may find ourselves.
Yeah, really nice meeting you, and thanks for edifying face today, Meb. Really appreciate
Awesome.
it. Good
Thanks so
hunting to
much.
you, buddy.
Cheers. Bye-bye.
Okay, everyone, that's a wrap. You can find Meb on Twitter and Cambria Investments. And I think that if you have your own pension and you're managing your own money, that could be a great resource for you in the markets. Think International. And that'll be a wrap. That will be a wrap for us. So I'm just looking to close it here. Hope everyone has a good day. Congratulations, all you precious metal bulls. Don't forget, take a little something off the table. And I'll see everyone tomorrow. Adios. Okay, you're very welcome, guys. I'm glad you enjoyed Meb. We'll see you tomorrow, investing.com Thursday. You're very welcome. You guys have a good day. Adios.